When it comes to wildfires and fire risk, you may wonder, why doesn't the insurance industry do more to help with fire safety measures? After all, insurers are the ones paying out claims when fires cause catastrophic losses, right? Well, the reality is a little more complicated, and in today's video, we're going to break it all down. Let's start with the basics, though. Insurance companies are experts at measuring and pricing risk, but they are not responsible for managing or mitigating that risk directly. Their role is to evaluate exposures, set premiums accordingly, and provide financial protection when covered losses occur. When it comes to fire risks, especially wildfires impacting residential communities, insurers can recommend mitigation strategies and offer incentives for homeowners and businesses that take proactive steps. However, they can't force anyone to make changes, and they certainly can't independently build fire breaks, upgrade municipal fire infrastructure, or create community evacuation plans. That responsibility falls primarily on homeowners themselves and local and state governments. Municipalities are responsible for maintaining defensible spaces, upgrading fire hydrant access, enforcing building codes and planning land use in ways that reduce community vulnerability to wildfire risks. States play a crucial role in broader forest management, firefighting resources, and public policy that influences development in high-risk areas. Our homeowners also bear responsibility. If you buy or build a home in a high-risk fire zone, you are inherently accepting a level of exposure. Taking proactive mitigation steps, like creating defensible space using fire-resistant materials and hardening homes against embers, is essential. Unfortunately, many homeowners either aren't fully aware of the risks or simply choose not to invest in mitigation measures. Insurance companies can only go so far. They can adjust pricing to reflect true risk, require certain basic mitigation standards for coverage eligibility, and offer discounts or preferred rates for properties that meet higher fire safety standards. But at the end of the day, they can't physically make communities or homeowners implement fire safety upgrades. That's where the disconnect often arises. In high-risk areas, when losses increase and risk modeling shows untenable exposures, insurers may raise premiums, restrict new business, or even non-renew policies. And unfortunately, because insurance is the face of financial protection, insurers often become the scapegoats for broader systemic problems, even when they have little control over the root causes. It's important to understand that fire risk is incredibly difficult to predict and manage at a community level. Factors like prolonged droughts, poor forest management, population growth in the wildland-urban interface, and aging infrastructure all contribute to the growing severity of wildfires. No insurance company can eliminate that risk. They can only measure it, price it, and manage their exposure to it. The real solution lies in shared responsibility. Municipalities need to enforce more rigorous building codes and land use planning. States need to invest in forest health and firefighting infrastructure. Homeowners need to take mitigation seriously and understand the true risk they're accepting. And insurers can continue to refine their pricing models, encourage mitigation efforts, and provide transparency about how risk assessments impact premiums and coverage availability. If all stakeholders work together, from individual property owners to policymakers to insurers, there's a better chance of meaningfully reducing fire risks over time. But if we continue expecting insurers to shoulder the full burden, we're only addressing the symptoms, not the root cause of the problem. If you found this breakdown helpful, be sure to like, subscribe, and follow Insa Knowledge for more insurance education, career insights, and industry analysis. Thanks for watching.